If you're trying to buy an Airbnb property right now, you're probably making these financing mistakes that kill deals. But here's the thing, these aren't complex problems. They're actually simple mistakes that destroy deals all of the time because nobody teaches this stuff. And today, that changes because you're about to learn exactly what you're doing wrong and the specific fixes that actually work. Let's go. The first mistake is what I call the loan type problem. And here is what happens. You walk into a big bank and you tell them that you want to buy a short-term rental property. And they're gonna quote you 7%, 8%, maybe even more, with 25% down. And they wanna see 2 years of W-2s proving that you can make enough to cover the mortgage without the rental income. Now, most people hear this and they think that's their only option, right? But that's like trying to use a hammer when you need a screwdriver. So here's what actually works. A DSCR loan, a debt service coverage ratio loan. And it sounds complicated, but it's beautifully simple. So these lenders don't care about your personal income. They only care if the property makes money. And here's exactly how it works. Let's say that you find a beachfront condo, right? That rents for roughly $3,000 a month. Your mortgage payment would be, $2,400, $2,500, and the ratio is 1.25. The property makes 25% more than the mortgage. Boom, you qualify, right? And when I was in the STR game, the DSCR loans were maybe 30% of STR purchases. Now, they're probably more 70 to 80%. So the whole market has shifted because they make sense for Airbnb properties. You get it? But here's what most people don't know. Not all DSCR lenders are the same. You're gonna have some that are going to require 12 months of short-term rental experience. Others don't, they could care less. Some will go up to 85% loan to value and others cap out at 75%. Some of them offer 40-year terms with 10 years interest only. And the rates will vary widely, right? I've seen them for 6.5% to 8.5% for the same borrower, okay? So let me show you the math on a real deal structure. Let's say the property price is $400,000. The rental income is $4,500 per month. The mortgage payment, the DSCR loan, is about $3,200 a month. So that means that the DSCR ratio is 1.41. Then you have to look at the down payment, 20%, $80,000. Closing timeline anywhere from 21 to 45 days. Now, compare that with a conventional loan. You need to be able to personally qualify for $320,000 mortgage. And the income requirement is going to be somewhere around $120,000 a year. And you can't count the rental income. And your closing timeline is probably going to get pushed back a little bit, 45 to 60 days. So you can see why the DSCR loans actually change the game. But here's where it gets even better. So even with DSCR loans, most people think that they need these huge down payments. This second mistake stops more deals than anything else. The second mistake is believing that you need 25 to 30% down. No exceptions, right? I call this the down payment problem. When I was actively buying and in the business, I quickly learned that putting 30% down on every deal is how you run out of money really freaking fast. The smart money, they preserve capital. Here are a few creative financing strategies that actually work. So the strategy number one would be the HELOC. You've got equity in your primary residence and it's just doing nothing, right? It's just sitting there. So pull it out at 8% to make 18 to 22% returns. That's a 10 to 14% spread, give or take, right? It's pretty simple math. Strategy two is the high LTV DSCR loan. So some DSCR lenders are gonna go up to 85% loan to value. If your credit score is above 720, that's only 15% down. So on a $400,000 property, we're talking about 60 grand instead of 120,000. Your buying power just doubled. And the third strategy is very creative and it can work. I've seen it before. Get the seller to carry a financing back. So either 10 to 50% in a second position. You put down 10 to 15%, you finance 75% with the DSCR loan, and the total cash needed, it's about 10 to 15%. The seller note is usually 4 to 6 or more % interest because they're motivated. Strategy number 4 is called the business credit stacking. So a DSCR loan for 75%, the business line of credit for 15%, you bring 10%. Yes, the credit line has higher rates, but if the property cash flow is pretty strong, then the math will work out. And here's a real life example. A purchase price for a property, let's say it's 350 grand. Traditionally, at 25% down, that's 87,500. The creative option is $35,000 down, which is 10%, plus 52,500 from the HELOC, which is an additional 15%. The HELOC payment is $420 a month. And then the property is going to cash flow anywhere from $1,850 per month after all expenses, or probably a little bit less. And then the net profit is going to be what it's going to be. So you're not hitting giant home run grand slams anymore, but you're still making money. And here's the deal. You use $35,000 to control a $350,000 asset that's making money, right? And the cash on cash return is going to be what it's going to be depending on your management. Now, even if you find the right loans and minimize your down payments, the third mistake is what separates the pros from the amateurs. Now, the third mistake is what I call the preparation problem. This is the silent killer that nobody sees coming, and it's so easy to fix. You find the perfect property, you scramble to get your financing, and by the time you get your stuff together, it's gone, right? In hot short-term rental markets, those properties were only gonna last a few days or a week, right? So you have to follow the pre-approval process to a T, and this is really important. Here's the exact preparation process that is going to work 100% of the time. The first step is you find a multi-lender pre-approval. Get pre-approved with at least 2 different lenders, 3 if you can, before you even look at properties. Well, why 2 or 3? Because each lender has different sweet spots. You have lender A, they might excel at condos, and lender B might offer the best rates on luxury properties, right? But lender C can actually close really fast. You just have to figure out what works best for you. Step 2 is make sure that your document package is ready. This is vital, right? So create a folder with 2 years of your tax returns, 6 months of bank statements, personal financial statements, which list all your assets and debts, LLC docs if you're buying in an LLC, and proof of reserves anywhere from 3 to 6 months of payments, and then any short-term rental experience that you have or long-term rental experience. And then you want to look at your professional rental projections for the target market that you're looking to buy in. You keep this stuff together, you come prepared, you are going to do better. And then step 3 is market research. So build a simple spreadsheet that shows the average daily rates by season for that area, the occupancy rates by month, your competitor analysis. So try and find at least 5 properties, maybe 10, operating expense estimates, and the lenders, they're gonna eat this up. And it shows that you're serious and you understand the business and you're not just, full of shit. But here's something that most people don't know. You can lock rates before finding a property. So some lenders will offer a 45-day lock with float down options, right? And follow along. The optimal timeline, week 1 to 2 is you submit the application to multiple lenders. Week 3, you compare offers and negotiate terms. Week 4, lock the best rate and get the full pre-approval. And then week 5 and beyond, shop aggressively with confidence. With this approach, you can close in 14 days with financing or 21 days, right? Cash offers typically want 30 days, and you can literally beat cash offers with speed, which is in your benefit. Here's what I'm gonna say. You need 5 very key relationships when you're doing this. A short-term rental focused agent, not your friend who got their license 2 weeks ago. Someone who's closed at least 20 plus short-term rental deals in the market you're looking at. The investment property lender, preferably 2 or 3 who specialize in different property types. A short-term rental property manager for accurate income projections, not just guesstimates, accurate. A real estate attorney for creative deals, and then a CPA who gets short-term rentals. And this is for cost segregation and tax strategy. This team is everything, right? The right team turns impossible deals into easy wins. Look, I've been in this game. I've owned short-term rentals, I've helped people buy them, and now I'm able to refer out to other agents all across the US. And I've seen these mistakes happen. The market's different now, but the opportunities are still there if you know what you're doing. Stop making the loan type mistake. Conventional mortgages are generally worse options for short-term rentals. DSCR loans let you qualify on property income and not your salary. Stop making the down payment mistake. There are legitimate ways to buy with 10 to 15% down if you structure it right. And stop making the preparation mistake. Get pre-approved, get your docs ready, and build your team before you start shopping. Here's the truth. Rates are 6 to 7% right now. They're not killing deals. The lack of knowledge is what's killing deals. The investors making money right now aren't smarter than you. They just understand these strategies. They have the right team and they move fast when opportunity hits. So if you are serious about short-term rentals in 2025, just level up your knowledge. And if you need an agent anywhere, nationwide, just click the link in the description, schedule an appointment with me, and I can connect you with anyone nationwide. And if you're looking specifically in the Pocono markets, just click that link as well.